markets for digital assets is historically volatile, though global, and constantly changing. This makes it interesting for institutional investors to track the space, and the reason that we have Crypto Clarified, the podcast where we help you navigate this fast-moving and complex space. My name is Benjamin Dean. I'm Director for Digital Assets at WisdomTree, and joining me today is my colleague, Blake Hyman, who's Senior Associate Quantitative Research at WisdomTree Europe. He's going to run through his outlook, explain to you some of the trends he's seeing, has seen in the past and is seeing coming in the future. I hope you enjoyed the episode, but before we begin, US listeners, check out wisdomtreeprime.com on the Apple or Android app stores. That's where you find the app if you're a US listener. For you other listeners, subscribe and share. 2 S's, alliteration. You can check me out at Benjamin Dean on the Bird app. Time for the disclaimer. Before I begin, I have to say the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, or as investment tax advice. The information and opinions expressed in this podcast are not a recommendation or a solicitation to buy or sell any securities. Reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. All right, let's go and chat with Blake. Welcome back to the show, Blake.
Thanks, Ben. Happy to be here.
It's always nice to have you on the show. And today, I'm sure the perspective you sit in will be somewhat unique and interesting, particularly to institutional investors who maybe aren't so worried or interested in the technology, but they are interested to know how the markets are evolving. Usually they evolve in response to the technology, at least historically, but that's changing a little bit. You and I have been doing this for a few years in Europe, and we've seen the composition of the market, the questions and pertinent topics change. Maybe just as some background for those who weren't on this thrilling journey of watching the ways in which the market's changed. But you just give some background on like when you started a couple of years ago and how that's different to what you saw 9 months ago. And then we can kind of continue on to talk about what's happened this year.
Yeah, for sure. So the evolution, I would say, from the institutional perspective has really gone from viewing this asset class as being obviously a very interesting and exciting technology, but struggling to, I would say, perceive the product market fit to actually understand, say, the value accrual type of mechanism and all of these things that traditional investors really want to find when they are looking at an asset class to invest in their portfolios. Part of this also has to do with actual access and understanding the underpinnings that kind of are foundational to the technology, which for crypto, it can be a bit confusing, which is why we love listening to this podcast to help shine the light on what's happened, how these things actually work underneath the covers in simplistic ways. But for institutional investors, prior to the launch of the ETFs in the US as being a key inflection point, the conversations were really educational. And since then, they have really evolved to allocation focused discussions and actual implementation, more so than getting on board with understanding the investment case and the asset class as a whole, and more so now execution focused.
You could maybe draw parallels with the early days of internet companies. I mean, back then, these business models come along, they're somewhat unproven, and a lot of investors it's not their game. They're not technology investors, so they don't really care what happens under the hood. They say, oh, the business model, I don't know, seems a bit faddish, might go away, doesn't really interest me. And what seems to have happened here, if we draw an analogy or parallel, is that some of these, you could call them business models, it's maybe not the best term, but some of these networks and technologies, applications, have actually proven to be resilient. Some generate revenue, some do other things like staking, others don't do any of that at all, Bitcoin. But that change, it's probably paralleled in early history, well, in more recent history, I should say. So what are they asking about then? Like, they used to ask me, what is Bitcoin? And who are you? But what do they tend to ask? I know you've touched on it briefly, but what are some of the questions they tend to ask? because that might help us get to some answers that are useful to at least this segment of the listenership.
Yeah, so I mean, some of it's interesting the array of questions. There's definitely the more sophisticated questions that are focused on asset allocation, focused on how does this actually mix in with the rest of my assets in a portfolio, as well as what are your views going forward. And that's really, I would say, a lot of what's driving the conversations more recently, because there was a lot of optimism, for example, going into the halving, a lot of optimism, at the start of the year, the first few months with the overall asset flows moving into the exchange traded products in the US. I believe now we're sitting at maybe 18 billion or so in new assets that have moved into Bitcoin, particularly. So, there was a lot of excitement in the first 6 months, and then the halving came, which led to this even more fervor for this asset class, and then things kind of sputtered out in the summertime. So there's part of it that is the quantitative stuff, that's the portfolio construction, but then a lot of it more recently has been thinking about this market environment and what is actually driving price action.
Okay, before we go on to the market environment, because that is something that is changing in many economies. It's always changing, right? But
Yeah.
we know that there are turning points in a way, or inflection points. Before we touch on that, uh, let's talk a little bit about your outlook then. So we've established Bitcoin ETPs in the United States, biggest set of ETP or ETF launches in history by inflows.
Yeah.
So suddenly, it, it's not going away, is it? Hmm. Oh, the biggest one in history. Anomalous. Now I can get access through familiar wrapper. Fine. Um, all of that has happened in the last 9 months. And yeah, while people go away on holidays, at least some people do during July and August, uh, it has started to flatten out a little bit. Um, so with that background in mind, then looking forward, what is kind of the areas that you're looking at or you think are particularly pertinent for the institutional investor out there who's looking at this space and is asking the questions like that which they ask you on a
Yeah.
daily basis?
Yeah, so I typically tend to frame, so my mind is very kind of oriented towards like the key variables, the key factors, the key things to be watching that are going to be impacting the price action. I mean, part of it is historically, but also as that trends forward, there is this, I'll say, leakage of the historical views into the future views. And some of the things that I would say over the last couple months that led to what we saw in terms of some of the price action in the summertime had to do with the selling of Bitcoin that was owned by the wallets that were managed by government institutions that had acquired the assets from collapsed exchange Mt. Gox, redistributed those back to the creditors. So we saw a massive amount of essentially what I would call, it's not outflows in a way, but it's sell pressure due to this increased, I would say, overall liquidity from a Bitcoin perspective versus having this supply being gobbled up by these ETFs for the first part of the year. So that kind of led to the rocky period where we saw over the summer months in July and August, which quickly transitioned to conversations around the halving's dead, all these concepts of like the halving not being a trade that played out, and then you start to have the political cycle start to play a bigger role. So what we tend to talk about is this evolution of perspectives, which is the first thing is this cyclicality that's introduced through the halving as well as the macro environment. So if I'm speaking about a little bit of the variables here, we had what was perceived to be quite positive for the halving, which I believe still is in terms of the reduction in issuance and this tighter supply. It was kind of counteracted in the summertime due to this release of additional assets onto exchanges back to creditors from Mt. Gox. And then so that kind of led to additional volatility. And now you're seeing the political environment and the geopolitics play a role, as well as the actual rate environment. So what was in the summer months was this supply demand type of driven environment has now evolved to politics, geopolitics, and macro. So over the last couple weeks and going forward, we'll be talking a lot about the macro and interest rate environment as well as the geopolitical environment impacting this asset class.
All right, let's focus on the macro one. Now, 2 to 3 years ago, the macro people told me rates are going up, Bitcoin dead. Uh, you have highest interest rates in the United States in 25 years. What happens? Bitcoin up. So, um, not to say I'm skeptical, but I did study macroeconomics and I know how their models work. I have been told one thing and watched the other thing happen in one of those fascinating ironies. And now I'm being told that interest rates starting to go down, good for liquidity, good for Bitcoin. And what's give us a rundown of what's going on here because uh,
Yeah, there's a lot
don't
of
paint me a skeptic or anything,
no,
but
no, no. I won't. I
I'm
would
sure
never.
people might be asking these questions, so I'm playing devil's advocate as
Uh,
I want to do. But your thoughts are probably more informed views here.
Yeah, so so the macro I would say is particularly with rates, I look at that as one key factor. So I would say historically lower rate environments better for risk on assets, which is why we saw significant I mean, at least is part of the reason why we've seen a significant increase in valuation of the overall crypto market. Particularly, we did have the DeFi summertime also kind of happening during this zero interest rate type environment that was an innovation that took place also during this a period of low rates. So you kind of combine those two factors, you get this massive increase in prices in the 21 end of 2021 period that led to these new all-time highs. So looking forward, I see this as being a positive thing. And we even saw a little bit of this reflected in the price action after the September rate cut with altcoins outperforming Bitcoin. So I tend to say that altcoins have a higher crypto beta, if you will. If Bitcoin's moving in one direction, altcoins are generally going to move at a higher magnitude in the same direction as Bitcoin. But it's been an interesting evolution because of this institutional wave that's kind of I would say shifted things here with Bitcoin performing quite positively year to date and altcoins underperforming, and it's particularly due to this new part of this new variable into the equation of these exchange traded products, exchange traded funds, and the institutional investors primarily moving into Bitcoin. So there's a lot of moving pieces to pay attention to, but the way I really look at it as liquidity is one thing, and historically it benefits. Now that's only looking at that in a silo, though. There's many other things, including the geopolitics and other things that are playing a role as well.
Okay, let's talk about geopolitics then.
All
Um,
right.
how does that interact? Um, we know that short term, historically, it has had impacts. Certain events that occur, and they affect not just the Bitcoin, but all kinds of global markets can be shaken, especially commodities, right? So it's not unique and is maybe a sign of this institutionalization or just growing adoption. But where does it sit now with geopolitics? Um, there are a few. There's always a few events happening, unfortunately. But where does it sit now, and how do you think about it or frame it?
Yeah. So the big thing right now, I guess if I look at one specific example, I would say that speaks to kind of how this fits in a portfolio and how this kind of is impacted by the geopolitical environment today. If we look back to Iran attacking Israel, we saw digital asset markets sell off during that event, where in a maybe in historical context, and people would perceive that Bitcoin has always been viewed as this hedge against geopolitical volatility, government collapse, the kind of like this scenario of I mean, there's the aspect of distrust in government institutions, but there also the aspect of, say, collapse and lack of stability. So with higher geopolitical risk, that leads to higher political and governmental and institutional instability. And we saw that during a short period of time, the week following or so, this attack, uh, digital assets sold off, where gold performed quite positively. So you had people, as well as treasuries. So you had people fleeing risk assets and moving to these more traditional safe havens, if you will, which I think has been something that maybe doesn't necessarily surprise investors that are the most astute with this asset class, but we do have to keep in mind the geopolitical impacts. And this is the reminder that I always give people, is that in the short term, digital assets are trading like a risk asset higher out on the duration spectrum, which essentially just means no cash flows slash cash flows that are extremely far out into the future, which tends to be where people need when people are seeking to have safe cash now, they're not allocating to these type of assets. So people are taking money from these areas, such as Bitcoin, digital assets, and allocating to them to other places in these 1 week time horizons. So as we look forward in longer terms, and this is where I almost go to the extreme in the conversation, talking about the rise and fall of different reserve currencies, as well as the strength of different economies across the globe. This is where you start to see Bitcoin have a very favorable type of I'll say profile, because you don't have all of these I'll say this counterparty risk with a government institution. You have the code base that is decentralized, anybody can access it, and it's going to run, and it's been running now for almost 15 years with no issues, with 99.9% uptime, and it has a clear monetary policy that's codified. So to really summarize all of this, the key thing that I'm talking about when I'm talking about macro and geopolitics is that we need to look at it in a long-term perspective, and there is going to be volatility during this time period when you are seeing this rise in geopolitical um, uh, rise in geopolitical volatility and risk in the space. So that's just something that I try to frame things out as people are thinking about, using it as, say, a hedge, if you will, which is sometimes discussed amongst investors.
Okay. So in this long multivariate equation, there's lots of variables.
Exactly.
There is one that's kind of emerged in the last few years that we've covered on the show before, but your view on it's kind of interesting. It's this stablecoin tokenized T-bill money market, like all this stuff that's moving onto Ethereum mostly. How does that impact the kind of investment case for Ether now that there are some products in certain jurisdictions that provide exposure? But why is that, in your opinion, could it be a piece of this multivariate equation, or is it just kind of like, I don't know, is everything driven by macro cycle?
No,
Right?
I mean,
And then
yeah,
I'm putting that out there as like the straw man, straw person.
yeah,
Uh,
no. Yeah, no, this is, and I love how you describe it as the multivariate equation, because that's exactly the way I think about it, and it's nonlinear. So it's not the straightforward approach. So you always have to take into account all of these things, and the growth side of the spectrum, which is this, I'll say, the adoption and the use case focused and the technology focused perspective is, one of the examples is what you just mentioned here with tokenized T-bills and tokenized traditional assets on chain, and the majority of those moving to Ethereum. And I think that that's really interesting, because it's kind of a transition from, say, a traditional retail user adopting a blockchain to provide or gain access to different products and services offered through smart contracts. So now you're having institutions do the same thing, where they're actually bringing their assets, their use cases on chain to actually support their businesses and their traditional offerings with this new technology, which is, I would say, a very important entrant into the space, because as exciting as it has been for a regular user like me, or even the different crypto startups and whatnot that are emerging on the blockchain to provide these exciting products and services, you're now having traditional players move there, which is really validation that, hey, this is something special, and this can disrupt real traditional business use cases, primarily financial services, with all of the things that I'm sure you've been seeing as well, with you being involved in the tokenization ecosystem and space as well.
yeah.
So I'd love to hear your thoughts as well on this, because I see the convergence of these two things happening, and this is just like a starting point.
Yeah, I said at the top, like the technology used to kind of drive the markets because it was very niche. Um, and really it catered to kind of the hobbyist, underserved portion of certain markets, which is Clayton Christensen's innovator's dilemma. That's where the disruptive things actually begin. Underserved market, new technology, better economics, demand that's latent, and too small for the kind of traditional players to want to play around in. Even if they wanted to, the economics don't add up for them. So now what we've seen is the stable coins prove that there's a market for tokenized US dollars. And it turns out it's a massive addressable market. I think I said on the show last time, I'll say it again. Tether, which is the largest stablecoin provider, is more profitable than Goldman Sachs. They have 50 to 100 employees. Goldman Sachs has 45,000. So what happens when somebody goes and proves that this model exists for an underserved portion of the market? Well, other players look at it and say, if we can emulate that or complement it, then maybe now the market's been proven, maybe we can grow up the market, which is typically how it works. Anyway, that's playing out. It's, of course, as you say, it's not a linear journey. There's exponents used and things like that. So, but you can start to see with network effects kicking in in certain portions of the market. And then you get the buyers and sellers, they're all basically in the same marketplace. Network effects, Metcalfe's law. So things can change very, very quickly. So we monitor the space. The way it links back to the kind of financial and markets portion is A, it's about creating markets using this technology, and B, it creates demand for the underlying cryptocurrency that is used when interacting with the market and participants on the market. So that demand side of the equation is being solved. And product market fit part that you said at the top of the show, where people used to go, what's the product market fit? And now it's like, well, it turns out the biggest provider is more profitable than Goldman Sachs. How big is that market?
Yeah, exactly.
So anyway, there's a lot of thoughts jumbled in there, but it is happening, and that is kind of how I view it. But I by no means am I an oracle of Delphi.
And I think that's why it's such an important piece to like put into the equation, because a lot of institutional investors aren't always aware of these things. Like they're focused on covering assets across the entire asset class ecosystem. So they're focused on their fixed income, their equities, their commodities, et cetera. And they look at digital assets in line with kind of what I was speaking about before, which is, risk asset, geopolitical risk, what's happening with, say, the US elections, for example, and what could be the impact there, which is why a lot of the questions and conversations hinge on those. But then the key thing is to also interject with the the focus that, hey, you have to remember that this is not just like something that you're like speculating on for the next quarter based on your asset allocation. Like this is a long-term growth technology that is something that should be a key part of the portfolio, and understanding the impacts and what's going to impact the actual valuation, adoption, you name it. It is tough to put together in this multi-variable type of world, but it is the growth is one of the key variables that, if you're in the quant mind, has a very big weight on that. So it's very important that we always address that.
Yeah, and it also comes back to, if you're sitting there in 2001 and the dot-com bust has just happened, and you go, why would I want some product that gives me exposure to, whoever survived this tech thing? It's nobody uses it, or like the business models aren't sustainable, or I'm not putting in the portfolio. Like it's not going in. And then 20 years later, it's the highest performing segment of the portfolio on a risk adjusted basis. So like that's kind of why I talk a lot about the technology and the use cases, because that will ultimately be the thing that drives sustainability of this segment of a portfolio, at least.
Mm-hmm.
But balancing that against one's risk tolerance and whatever one else has in portfolio given investment desired outcomes is kind of, as you say, you got to take all these other things into account. And we can talk about correlation. We've talked about it before, but it is one of those ones where if, for whatever reason, this segment of the portfolio it became more correlated with others in a medium to long-term trajectory, then you'd have to revisit it. But for the moment, it's got very low correlation and has historically. But that doesn't mean the future's the same, right? So they're all important things to consider.
Yep, exactly.
Great. So that's been very informative. Is there anything else you'd like to add before we call it a day on this one?
I think because I alluded to U.S. politics and I didn't really address it in the geopolitics piece, that tends to also be one of the key questions that are very a lot of the investors are very focused on, given it's right around the corner. So I would say I'll just kind of repeat what I talk about with clients is really that, as we see this, we expect volatility going forward, particularly around the political environment. Now, there's a lot of positive things with the rate environment, as we talked about. We talked about the growth, so these are like I would say positive weights on your variables so far. And then you have this question around the geopolitics and the politics. And I would say the key thing in how I frame it up is that if we have geopolitical risk, particularly issues with Iran, et cetera, evolve and grow, that's obviously going to be bad for digital assets going forward, at least in the near term from an investment perspective, say over the next 6 months, because people will source that liquidity from the risk assets, like we saw with the unwinding of the yen carry trade and things. If you revert back to that example, um, and as we saw with the recent launches. Now, shifting to politics. Now, if we see the geopolitical risk kind of decline over time, and we also in the political sphere and the macro sphere have, say, soft landing that everybody's hopeful for, and now I believe, I can't remember which bank actually called it officially. Um, so we have had good macro data that points towards a soft landing, which is nice. And then we also have this rate environment lowering as well. So this is also another positive, general positive, weight on that variable, if you will. And then the U.S. political one is the real questionable one that I would say I don't have a weight on it yet, as in terms of a positive number or a negative number, because in the political realm, President Trump has been quite positive towards the asset class, as many of your listeners are probably aware. He's obviously has a very distinct personality, as well, that comes with a lot of other baggage potentially. But for the crypto environment, it could be quite beneficial if there is a change in leadership from the SEC, which is what he's claiming to make happen if he is reelected. And then you also have his policies that I think are important to acknowledge, which could be beneficial for Bitcoin, particularly with budget deficits continuing to grow, tariffs, and potentially higher inflation on in the longer term. So these type of things are, I would say, just to kind of put this into a key thesis for the Bitcoin focus, particularly with U.S. politics, is if Trump is elected, digital assets could be benefited from him, particularly on the enhanced innovation through more supportive regulation, as well as his policy actually leading to, I would say, the Bitcoin thesis being uh, playing out even more strongly because of greater budget deficits and higher inflation in the long run. So that was a lot to add in at the final, Ben. So I apologize, but that's always a very important thing that clients are asking about as well.
It's interesting that they're so focused on that particular one. Like I can see the point. It's regulation as facilitator or inhibitor. And a lot of them had the thesis for years. They used to say this to me: "What happens if the government bans it?" Let's not get started. Yeah, there's one last thing I want to bring up, though, Blake, and here's one that you might have an answer to because it perplexes me, perhaps from where I sit. Macro, interest rates, Fed, US, I get it. Like, still the world's second largest economy, nothing to ignore. Why don't any of these people ever talk about the People's Bank of China and what's going on there in the same context? Because that's the world's largest economy that's pumping liquidity into the system still. And I would have thought that if someone's not paying attention to that in this context and discussion, then they're probably missing a huge piece of the puzzle. But I know we don't have a lot of time, so I don't want to just open Pandora's box up. Maybe we talk about it next time. Do you have any quick thoughts on that one? Because I watch it and I just think that it's so weird.
Yeah, no, you're right. We definitely do focus on the U.S. a lot, and the China's stimulus is huge, and we've seen the price reaction in Chinese equities, but we haven't seen it in digital assets particularly yet, because I would say most Chinese do not have access to digital assets unless they've changed the actual ban. So I might have missed this if something's been changed, but they're quickly, they're rushing to get access to invest in Chinese equities more so than digital assets.
That's cool. Maybe next time we talk about that, just because the people I spend time with, and they have access.
All right. Okay. See, that's good to know. That's very good to know.
But we can talk about that next time. Blake, thanks for taking the time to chat with us today. I hope everyone found it informative. We'll have you back on again really soon for this recurring segment.
All right. Thanks, Ben. Really appreciate it.
Well, there you go. There you have it. Blake Hyman from the research team at Wisdom Tree Europe. US listeners, wisdomtreeprime.com. Check it out at the website or find the app on the Apple or Android app stores. You can find me at Benjamin Dean on X. Well, I hope you enjoyed the episode today, institutional investors. I hope you found it informative. Thank you for joining us, and I hope to see you again very soon.